Good morning and welcome to the Killik & Co Market Update. This week we've had the Nato Summit and Donald Trump has been quite critical about the amount that other countries spend on defence. And if you look at the numbers, I think he does have a point. So countries within NATO are supposed to spend 2% of their annual GDP on defence. And if you have a look at these numbers here, you can see that many countries are falling well short of that. So the US is way ahead of everyone else. They are spending 3.6% of their GDP on defence. The UK is okay, we're just about on target, we're spending 2.1%, but many other countries, particularly major economies within Europe, are falling well short. So France, they're spending 1.8%, Germany very low at 1.2%, and Italy even lower at just 1.1%. So it's understandable that Donald Trump has an issue with this, and he has been pushing quite hard for countries to increase the amounts they spend on defence. And that's why he has been threatening to pull the US out of NATO. And actually after the summit this week, a number of leaders did admit that they do need to increase the amount they spend. And that this week has been quite good for defence stocks, and we have seen a bit of a rise in that sector this week. And it's not just the more traditional defence stocks such as the weapons and the aircraft manufacturers, it's also cybersecurity. So over the last few years, the threat of cybersecurity and cyber attacks has increased, and we have seen governments and businesses spending more and more money on cyber protection. And there are many people that think that if we do have another war, it probably will be a cyber war. So that's why cybersecurity has become an important part of NATO's policies. And when we look at this spending, cybersecurity is a very important factor. If you would like to speak to someone in more detail about cybersecurity, please do call one of our investment managers. Last week we talked about the expected release of Theresa May's White Paper on Brexit, and this week it has finally been released, 2 years after the referendum. So we've been looking at this to see what kind of future trading relationship we can expect to have with the EU. And this is crucial because the EU collectively is by far the UK's largest trading partner. So have a look at these numbers. In 2017, the UK exported £274 billion worth of goods and services to the EU, and that accounted for 45% of our total level of exports for that year. Then looking at imports, we imported £341 billion worth of goods and services from the EU, and that accounted for 55% of our total imports. So it's crucial that we get some good agreements in place for our future trading relationship. So having a look at the white paper, it does appear we have got some good news for the goods sector. So it does look as though the UK is aiming to set up a free trade agreement with the EU in regards to goods. And at the moment, our largest goods exports are vehicles and chemicals. So in 2017, we exported £18 billion worth of motor vehicles to the EU and £15 billion worth of chemicals. So I think the paper will be good news for those two sectors. However, the paper's contents in regards to services was slightly less positive. So at the moment, the EU has something called passporting rights, and that means that a firm regulated in any one member state can promote its services in any other member state without the need to be regulated separately in every individual country. So we were quite concerned about how our services firms would operate in the EU after Brexit without having these passporting rights. And it was hoped that we would go for something called mutual recognition, which would essentially have been passporting with a different name. However, the Brexit paper makes it clear that we will not be aiming for that type of agreement. So at the moment, the situation with regard to services, particularly financial services, is quite unclear, and the city has reacted quite negatively to the paper. So we'll have to wait and see what happens there. And also this week, Donald Trump has suggested imposing yet more tariffs on China. And this has taken some people by surprise, and it has caused a bit of volatility in global markets. So the level of proposed tariffs, I think, is much higher than what many investors were expecting. And I've just taken this chart here from the BBC, which I think gives quite a clear indication of the levels of tariffs that could be imposed in the future. And so initially, the US suggested imposing tariffs on about $3 billion worth of goods. So not a particularly high level of goods in the grand scheme of things, and when that was first announced, it didn't have a huge impact on markets. Then last Friday, the US formally went ahead and imposed tariffs, and it imposed those tariffs on $34 billion worth of goods. So quite a high number, but still not hugely significant in the grand scheme of things. However, this week, Trump has come out and said that he wants to impose further tariffs on $200 billion worth of goods. So that is a big number. That has caused a bit of concern, and therefore this week we have seen a few wobbles in global markets. So we will have to wait and see whether the US does go ahead and actually impose those tariffs on the $200 billion worth of goods. Now, looking at the week ahead, looks like quite a busy one, lots of different companies reporting. I'm not going to list them all, but to name a few, we've got BHP Billiton, Goldman Sachs, United Health and Microsoft. That's it from us. Have a great weekend and we'll see you next week.